We have a company initiation on UOL Group. Okay, we are initiating coverage. We are giving a accumulate rating. Target price is $7.05. Last close was $6.29. 52-week range was $5.22 to $6.38. Market cap is $5.1 billion Sing dollar. Okay, UOL well probably doesn't require much explanation. I mean, most of you probably have heard it or know about it. So it has three primary business segments. Actually, altogether there are five business segments, but we'll just focus on the three main ones. They are property development, property investments, and hotel operations. So apart from property development, property investments, and hotel operations are a recurring component of its business. Now, we jump right into property development. So for UOL, in the Singapore development scene, it's actually sitting on a rather comfortable position, all thanks to its nimble and very well executed development strategy. So if you notice that or wrong, I mean, I would say that if we understand, UOL has been very nimble towards how they push out development projects. So just in 2015, there were only two launches, and 2016. So from upon launching in 2015 all the way to now, they've been focusing on marketing the existing properties that they have on hand. So compared to other developers who may be aggressively still going out to buy land and develop, get planning approval and sell, UOL on the other hand has been very nimble, and again I repeat. So what they've been doing has always been remaining laser focused on on pushing out good projects and selling them at good margins. At this point of time, as at the third quarter of 2016, there are only two launch projects remaining with more than 10% unsold units. So we will explore them as we go into the next slides. Okay, the first project which has more than 10% unsold units is Principal Garden. It's located in the District 3 of in Singapore. It's around the Bukit Merah region. So take-up rate has been very encouraging. It's 47.1% sold as at third quarter 2016. So this project was launched in October 2015, and just within a short span of a year or so, there's really 50% take-up rate. And while the take-up rate, of course, it does sound not that spectacular when you compare to some other newer launches like Forest Woods, which sells like 50-60% within a weekend itself. But it can't be compared like this. At the end of the day, Principal Garden is a much bigger development, or in other words, units in Principal Garden is actually much bigger. You're looking at something like 1,200 square feet and above. So just reiterating what I've said 2 months ago about the property development scene. At this point of time, because of the ongoing property cooling measures, for example, the 60% total debt servicing ratio, the quantum of a property is actually very important. That is to say that if a property price is too expensive, some buyers are actually driven out of the market. Or in other words, we say that like they can't go to the bank and get a loan for the property. Now, for Principal Garden, like I was saying, there is 47.1% sold as at third quarter 2016. There's still plenty of time remaining for them to sell before they get the ABSD clawback, which happens in April 2019. So essentially, you're looking at least 39 months that they can sell the property. So what's really good about the execution or the strategy that UOL has taken is that compared to two nearby developments, which is the Crest and Mont Jervois, land cost for Principal Garden is actually the lowest. Therefore, is able to sell at a lower price, but at the same time still get good development margin from this development. So in other words, as your cost is lower, you can price the properties lower, At the same time, it also benefits the home buyers because they can buy it cheaper. So it's a win-win situation in that sense. Now we can examine this particular property just a bit just a bit more in detail. So Principal Garden, and if you notice that Principal Garden, the Crest and Mont Jervois, they are just within the vicinity. So why is it that, okay, just a bit more here is the Crest and Mont Jervois, they are facing ABSD clawback in a few months' time this year. So if I'm not, I don't remember the dates offhand, but the Crest and Mont Jervois, either one of them is facing ABSD clawback sometime in April, if I get it correctly. So so why is it that Principal Garden sell better compared to Mont Jervois and the Crest? Like I said just now, is definitely because of the well, one thing is the price is lower, and the next thing is that for home buyer, when it comes to this particular development, if you stand around, just imagine you standing around this area, it's just within uh, it's just within the vicinity, and that is to say that it's any price differences or significant price differences will make a home buyer turn the other way. So if and at this point of time, Principal Garden is selling at $1,600 per square feet compared to the Crest, which is 1,008. Mont Jervois is more than $1,800 and above. So it just doesn't make sense for home buyer to fork up $200 per square feet more. And if you're talking about $1,000 if you're talking about 1,000 square feet property, a home buyer has to come up with at least an additional $200,000. And again, we take into consideration of the 60% total debt servicing ratio. And if they aren't able to get a loan, if getting a loan is very challenging, having another 200,000 is going to make it even more challenging. So we think that it was definitely very good execution here, coming in to get the land at the right price. Okay, now next, the second development that has more than 10% of unsold units is actually Riverbank at Fernvale. It's a 555 unit condominium in Sengkang. It's 89% sold as at third quarter of 2016. So again, UOL has no rush to sell the remaining units in this development because it has more than 15 months to sell the remaining units, 60 remaining units. If you just average it out, 1 month they just have to clear 4 units or so. So if you happen to follow or happen to look at the ULA transactions, you can see that Riverbank is selling at like on average 1 month 10 units or so. So selling 4 units per month for the next 15 months doesn't sound like a very incredible feat. But on the other hand, the development margin in that development is based on our expectation, it will be rather weak at around 8%, and this is because of the oversupply of units in the OCR segment. And I was actually talking about this 2 months ago while we talked about the property sector. We had a property sector coverage then. So okay, again, for Riverbank at Fernvale, UOL did a good job there by bidding, or essentially among other developments that is on sale now, Riverbank at Fernvale actually has the lowest land acquisition cost or the lowest land cost. So again, I will just repeat what I've said just now. I mean, a few months back. Recall that the majority of most of the cost of a property development actually comes from 2 factors. First is land cost, and next is a construction tender. So if land cost itself is high, there's not much flexibility, not much room for a developer to actually price to price their properties. So why is this an important consideration? Is that imagine in a down market, for example, right now when markets isn't that is more lackluster, when cutting prices is a necessary strategy to take. But if land acquisition cost or cost is already high, there's not much flexibility or not much room for them to adjust prices. So compared to other developments that have lower costs, a development with higher costs will definitely be disadvantaged. So the chart below here is actually the historical transacted cost of the development. So you can see that for the past 1 year or so, since January 2016, you can see that it's still being sold at very good margins, or essentially at very good average selling prices, ASPs, all the way until the later part of the year in October and November 2000, October, November, and December in focus, when it came down to a lowest point around 940 over dollars per square feet. But it's still okay because nonetheless they are still making money. So being able to sell more or faster in the initial phases is actually in the advantage of a developer. Why is it so? Because think about this, for the remaining 11%, even if they are to sell at a break-even cost, they will still make money on the entire development. Okay, now after, say for example, after they finish selling Principal Garden and Riverbank at Fernvale, they are intending to launch 2 other development projects each year in 2017 and 2018. So these 2 development projects, the first one is in in Clementi Avenue 1. The name of the project has already been released. It's called Clement Canopy, which is a 555 unit development project. So we expect it to be launched sometime very soon in the first quarter this year. In fact, the soft launch is already there's already a soft launch for the property. So essentially, what happens next is definitely the official launch, which you shouldn't take too long. The second property is it's a 750 unit development in Potong Pasir. So we expect them to launch this. They just got the land sometime in November last year. So if you just project around a year for planning approval to be ready, and probably another few months before they prepare marketing material. So it's realistic to assume that they will launch in 2018. However, for these 2 developments, because of the weaker market conditions, it's most likely going to result in lower development margins. So for us, we use a development margin of 10 to 12%, and the whole point of taking a lower development margin is to stay conservative. Nonetheless, these 2 projects will add $50 million or around 6 cents to our RNAV estimates. We'll get to that later. So much about the simple market. UOL has already done or gone into diversification into overseas property development. At this point of time, on hand, they have 2 properties in the Chinese market or in the China market. The Esplanade, which is a 570 unit residential and office development, is really 95.1% so TOP. So it's as good as a done deal. But at this point of time, it also has Park 11, which is a 398 unit residential development in Shanghai. In September 2016, last year, they have a private launch of 168 units. Just within a short span of time, 80% of the units have already been sold. So the remaining 230 units, we expect them to launch sometime very soon. So I'll provide updates as they are available. The next development project that they have is in London in the UK. It's at the Bishopgate land site, which is 160 unit freehold mixed development. At this point of time, they are trying to 160 unit is based on their projection. So, but because the existing building or the existing land plot can only tolerate, if I'm not wrong, it's up to 130 units. So they're trying to get planning approval in order to expand the number of units, or to expand the number of units for sale from 130 to 160. But nonetheless, you expect them to be launched in 2016. So all in all, these 3 projects will potentially add $103 million or 13 cents to our RNAV estimates. Okay, having said all this about property development, What is important to identify here is UOL derives 65% or more than 65% of their operating profit from recurring income from the other three segments of hotel operations, investment properties, and other investments. These other investments is pertaining to the listed securities that they own. They own 43% in UIC, as well as a 2.3% stake in UOB. Nonetheless, again, lower reliance on property development actually pans out well during weaker markets because as we know that sales in property development or performance in property development is rockier. So this is definitely, again, why is this in comparison? In comparison to recurring income base, say for example, investment property and office property, where a tenant has to shell out or pay rental on a monthly basis. Okay. Now we look into the hotel operations of UOL. So for UOL, they own 33 hotels, or is equivalent to 9,864 rooms across different locations in Asia, Oceania, and North America. Their hotels are primarily under the two brand names of Park Royal and Pan Pacific. So for their hotel operations, Singapore and Australia contributed more than 68% of the entire segment revenue. So it's very important to pay attention to these two geographic. Okay, over in Singapore, the international tourist arrivals was up 7.9% year on year in the first 11 months of 2016. And the increase was primarily driven by a growth in Chinese and Indonesian visitors. So Chinese visitors actually had a astounding growth. It went up by 36.1%, and Indonesian visitors was up 5.9%. Then we attribute the better tourist arrivals or higher tourist arrivals, especially Chinese and Indonesian visitors, from the depreciation of the Sing dollar against their domestic currency, which is the Indonesian rupiah and the renminbi. And if we just pay attention to the chart at the bottom, the Sing dollar has depreciated 3.6% against the RMB in the second half of 2016. So we can see that from July, around the July period of 2016, we start to see that the Sing dollar turned the corner and she start coming down very sharply from then. Similarly for the Indonesian rupiah, Sing dollar also depreciated 5.8% around the same time as well. That was in July 2016. So apart from foreign exchange, the influx of Chinese visitors is also partly due to the increased marketing efforts by the Singapore Tourism Board. So what they have been doing is that they've been promoting Singapore as a tourist destination to second-tier Chinese cities. So these second-tier Chinese cities are somewhere in Chengdu, Xiamen, etc. So the people who really came here were the people who have not visited Singapore before. And again, back to foreign currency wise, we expect the Sing dollar to continue a downtrend in the first half of 2017. Okay, now moving over to Australia. Australia, just like Singapore, also experienced a phenomenal growth in tourist arrivals. It grew 11% year on year within the first 11 months of 2016. So out of the 20 inbound markets or top inbound markets, 15 of them actually came in at record levels. So the particular market that has grew the most was again the China market. The Chinese visitors actually grew the most at 21%. But unlike the case of Singapore, where tourist receipts didn't grow as much as tourist arrivals, the case in Australia is such that the tourist arrivals actually grew just as much as tourist receipts. Oh, sorry, the other way around. That is to say that tourist receipts grew just as much as tourist arrivals. In other words, just in simple terms, These tourists are coming into Australia, and at the same time they're spending just as much too. Now, in terms of foreign exchange, the Australian dollars appreciated 8.5% against the Sing dollar in the second half of 2016, contrary to a depreciation in rupiah and RMB. Appreciation of the Australian dollar actually panned out well for UOL because of potential translation gains. So as to say that like the hotel operations in Australia, because they are charged in the Australian dollars, when they're repatriated back to the Sing dollar, they'll make a translation gain there. Okay. Now further in their hotel operations, there's a clear pipeline of expansion strategy. They have around 9,600 rooms that are that are in operation now. We can expect room capacity to increase further by 16.9%, or that is equivalent to 1,672 rooms in the next 3 years. These new hotels, there will be 6 new hotels to house these 1,672 rooms, and these new hotels will be mostly located in Asian countries, Malaysia, Indonesia, and Myanmar. These new assets, based on projections, is expected to boost existing hotel operation revenue by 8% to 12% per year. Okay, the final segment is property investments. UOL has a diverse base of Singapore investment properties. So to say that, like, if you just pay attention to the chart here, they have assets, they have office assets, retail assets, as well as service suites properties. And these different types of rental properties actually provide stability to operating performance. And again, just to highlight again, not relying on property development contribution actually pans out well for them, especially in a weak market like this. So having recurring income in a market like this will actually help insulate their earnings. In terms of their office properties, they own 5 office properties in Singapore, and most of these properties are located in the fringe area of the CBD. Vacancy rates of fringe office properties have been consistently lower than the other 2 segments. These 2 segments I'm referring to are the central region as well as the outside central region properties. If you look at the chart at the bottom here, you can see that the fringe office properties have consistently have lower vacancy rates as compared to the other two market segments. If you just pay attention to since the second half of 2015 or so, or all the way into the first half of 2016, you can see that instead there's a divergence in terms of vacancy rates. You can see that fringe properties are actually vacancy rates are actually going down and stabilizing around the 8% area. On the other hand, central region properties as well as outside central region properties have been increasing, or vacancy rates have been increasing. So why is it so? Is nonetheless because of the amount of supply that is coming online. So now you just shift your attention to the chart beside here. Construction activities in the central region is still at a very high level, looking at 500,000 square meters or so, and you're expecting around 20% of these supply to come online within this year. So as to say that if you just look at vacancy again, we don't expect vacancy rates to drop anytime soon, at least for central region properties. Okay, now just another point to highlight. Group's occupancy rate, or UOL's occupancy rate in terms of the office properties, are much higher or significantly higher than the fringe occupancy rate. So the group's portfolio is 94% versus 92%. Now moving away from Singapore, in 2016, UOL has acquired 2 mixed-use buildings in London. in the UK. So the first property is 110 High Holborn. It's a freehold 8-story building with 10,873 square meters of retail and office space. It's very conveniently located. It's just 100 meters away from Holborn Underground Station. And the second property is 120 Holborn, which is a freehold 9-story building with 32,431 square meters of retail space and office space. It's located in the Farringdon area. It's while the location is not as um, the location of the property may not be as close as to the station as compared to 110 High Holborn, but 300 meters is still within walking distance. Nonetheless, at this point of time, we what can be said is 40. You can be sure that around 44% of the net leasable area will be used for retail, and the remaining will be used for office space. Now, just a bit on the office landscape or the office property landscape in the UK. In the third quarter of 2016, vacancy rates is at 3.4%. While 3.4% may be at a 12-month high, but when taking into consideration of the 10-year average of 7.9%, 3.4% is still significantly lower than that. And furthermore, if you also take into consideration of the slowing construction activities of new offices in central London, you can expect supply to remain tight. And because of this, we can expect further cap rate compression in these two UK properties. Okay, the risk to our views is that in terms of upside, of course, the thing that um, people will be hoping for is the unwinding of property cooling measures with ABSD and the 60% TDSR in focus. The next factor to actually that might actually be a boost to real estate is the broadening of immigration policy, and finally the depreciation in the Sing dollar will further boost inbound tourism to Singapore. Now the downside over here is that a further slowdown in the Singapore real estate sector, and of course the unforeseen circumstances like terrorism and pandemic, they are adverse to the hospitality subsector. Okay, and finally, this is our valuation methodology. So for investment properties, we apply appropriate cap rates on NOI or net operating income. And for development properties, we value them at NPV, taking into account of the after-tax cash flow minus away all the other associated costs. So when total gross asset value, including the 44.6% stake in UIC and 2.3% stake in UOB, we get RNAV of $6.3 million. So $6.3 million, when you look at a per share basis, is equivalent to $7.83. But we've decided to take a 10% discount to RNAV, and that gives us a target price of $7.05. And with that, we've come to the end of our presentation. So feel free to ask any questions you may have. Hi everyone. I got a question on Brexit. How Brexit will impact the growth in UK for UOL. So okay, the simple answer to this question is just now I was talking about the what happens to the uh, what was happening to the property landscape or the property market in the UK. So uh, just just a bit more sharing here. Since Brexit, which is sometime in July last year, yes, correct. There was an impact on real estate, and more importantly, what happens quickly after that uh, was in fact was in fact more people actually came in uh, to to pick up these properties. And why? I'm sorry. Let me just say this again. So initially, what happens then was that capital value actually dropped. So there was a cap rate expansion. But shortly after that, within 2 or 3 months, we saw cap rate compressions, or essentially what caused this cap rate compression was that more people came in to buy and support and support the value from dropping. So as more people came in to buy, we saw cap rate compressions. So going forward, we I would like to think that what happened to Brexit is actually a situation that was overblown. Add on to what I say previously is that at the end of the day, real estate is really about supply and demand. So if you consider moving forward, the amount of office space in UK is really, I mean, central London is as developed as it has been already. So especially just now when I was sharing, let me just go back to the slide, which I talked about it. So if you try to understand here is there is a slowing amount of construction activities in central London, and you can expect supply to remain very tight here. So going forward, you definitely can expect some form of increase in capital value in the form of cap rate compressions.
Hi, this is I think macro analyst. I have a question on how the stock market movement will be with Donald Trump's presidency. This was covered in our last webinar. Just to recap, what we feel is that the stock market for especially the U.S. equity market has actually risen to quite a high level in terms of valuation, but we see sentiments actually picking up. Retail investors are actually getting back into the market. It's pushing the market much higher. So just looking at this past data and the past price movement for S&P, it seems that the Donald Trump presidency seems to be a positive news for the U.S. economy. But we have our views to check back our webinar for a more detailed answer.
Hi, I got a question on will rising interest rates affect the property market? The answer is yes, in short it will, but we expect interest rates increase to be gradual. So in other words, you do not expect a very big impact on the property market. So at the end of the day, let's consider from this point of view that in Singapore, in terms of employment, unemployment rate, it may have tipped up a little, but it's still at a relatively low base, which is around 2% or so. So having said that, I believe that the rising interest rates, as long as it's gradual, it wouldn't have too much impact on the property market. Okay, may I just remind everyone again that we are doing a survey. So if you could just help us to just fill up the survey at the link is inside the chat box. Hi, if there are no further questions, we'll conclude our webinar for this week. Hope to see everyone again next week. Thank you.